Warning Wednesday. Hi, welcome to the Froggy Five. I'm your host, Jim Froehlich, founder and managing partner of Froggy Companies, where when it comes to real estate, you can't stop the hop. I want to get a warning from you about it. It could be about your tech guy running off with half the money, or it could be about real estate, like just some kind of warning, something, a hard lesson you've learned that now you've adjusted your business to based on that.
Oh man. All right. Well, I can give you a couple, and I'll keep them really quick. So one of the things, for anyone who out there who's thinking about becoming a landlord yourself, cash flow is not the rent minus the mortgage. And it sounds so simple and so stupid. And, when I was in my 20s, I'm running around thinking that was true. And because that's what the average person thinks, right? They just don't know that you're going to have these irregular but inevitable expenses as a landlord, things like vacancy rate, things like repairs and maintenance, and costs like property management. Whether you outsource that or not, it is a labor cost. You can pay someone to do that labor, or you can do that labor yourself. But if you do that labor yourself, it's still a cost, right? It's still your time. I mean, when I first moved to Abu Dhabi, moved over there with all my rental properties, and it became glaringly obvious just how much I had been subsidizing those properties' returns with my own labor. So the returns that I was seeing on paper for just the money portion were skewed because I was putting in dozens of hours every month to keep those properties going, even though I had a property manager. So, if you took the value of my time and put $1 on that for my labor I was putting in every month on those properties, I was way underwater on those properties, right? So anyway, a quick rule of thumb, 50% rule. This will keep you conservative. 50% of the rent is going to go to non-mortgage expenses. And if you look at things through that lens, then you'll start saying, oh, well, how could I ever make money on a rental property? That's exactly the reaction that you should be having. It's hard. You can do it, and people do it, but it takes a lot of expertise and it takes a lot of work to find deals that good. So anyway, that's one. There are risks that come with passive real estate investments too. I mean, we have seen a couple deals go badly in our investment club. Now it's a low ratio of them, fortunately. We've done 20 some deals in the club, and we've seen one deal went very badly. One of them is doing a capital call. So it's yet to be seen how that will resolve itself. But these deals, when I first started investing passively in real estate syndications, everyone kept saying, oh, vet the sponsor. And that's great advice. But part of the way that the average person, or at least the average new passive investor, vets sponsors is by asking around about their reputation, which you should do, and it does matter. But those two deals that have been a little shaky that we've done, they were two of the earliest deals we did. Those were with sponsors who had a stellar reputation in the industry, and they've both since really cratered. I mean, so reputation it does matter. You should ask about it. It's part of due diligence. But it's not everything, and you have to do your own due diligence beyond just asking a handful of other passive investors, what do you think about this person? It's a little odd. What we have found over the last 2 years in the much more challenging commercial real estate environment that we've been in, we've actually found that some of those really big name sponsors, and again, I can't say them because I don't want to be sued for slander or whatever, but those big name syndicators, they were out there spending a huge amount of their energy building a brand and selling these kind of secondary services based on their brand, like coaching, like mastermind groups, that sort of thing. Whereas we've seen better success and better weathering of the storm over the last couple of years from the mid-range and even some smaller operators who they're just like laser focused on their property deals and making sure that those deals stay profitable. That's their only focus. They're not out there worrying about, building up their brand name or their thought leadership or any of that nonsense.
Mm-hmm.
They're not selling the $20,000 mastermind programs or whatever. They're just real estate people, and that is where the buck stops. Basically, they're going to
Yeah,
make sure their deals perform hell or high water, and that's it. So, anyway,
that's
just a couple thoughts and
good
observations that
insight.
we've seen.
Yeah, that is great insight. I'll try not to pontificate over both of those too much. But the first one, I'll say earlier on, I was going to say it took you 9 years to decide not to be a landlord because it took me about 9 days. Uh, when we started what we thought would be our Froggy empire, and I had visions of a REIT and all this kind of stuff, and we'll manage stuff. And I said to my wife, "Well, you're better with people than me. Like you're more assertive and you're better with contract. You'll be the property manager." And like I quickly realized that. But then, seeing a few eviction processes and dealing with some late night things, and this is just locally, not managing from a distance. And then I have a sister who has a cabin in Georgia, and she sort of does it from a distance with the short term rentals. My wife did short term rentals and then long term rentals. And speaking of independence, she finally just became independent on the last property, a couple months ago. I'm like, yay, you're free. You don't have to do that anymore. And this was with that property was with a friend, and we had helped rehab a place, and it was profitable to an extent, but we weren't really charging a lot of, property management fees related to that. But it's just, yeah, it's a nightmare. Some people want to be in property management and love that, and some people can pay for the margin. But like you said, you expect your margin to be a lot bigger for capex and opex and everything in there, and just know what you're getting into. The biggest thing I think, though, that's still attractive in that area are the tax benefits. So if you can still be tied in and get all those tax benefits that are for those types of rentals, it's a step above the normal tax benefits you're going to get through passive investing, right? And then, I mean, I do due diligence. When I do due diligence, it's like
You go deep.
Yeah, we go pretty deep. So if somebody's hiding something, we'll know it. Or other people might just gloss over that, surprisingly. But if you're placing $50,000 of someone else's money, you better know that you've covered your tracks on that front, right? But then the deal itself, you got to know the deal, and you got to know, is there a backup plan to this deal, and are you lying to yourself? I think we just get hundreds of deals every day in our inbox right now, and I feel like most of them aren't that good. People are still counting on appreciation. People are still saying we're going to build this to a 7 cap and sell it at a 5 cap, or we're going to refinance this 100 unit and we're going to raise rents. And it's just deal after deal where I just look at it and say, forget if the sponsor's got a stellar reputation. A lot of the ones with stellar reputations are in a situation where they have a standing army to feed, or where they have a lot of money they have to deploy. And that's what I find. Then people are, regardless of how much they can buy in bulk and get some kind of discounts because of their money, a lot of them are making what we would deem as small guys to be a marginal room for error.
Yeah. Well, so to tie together two things that you just touched on, actually, property management and how these sponsors operate. One of the things that we have really honed in on in our investment club is looking at property management risk and construction risk. And we're agnostic about whether that's vertically integrated by the sponsor, right? Whether the sponsor is doing the renovation and construction work, whether they're doing the property management versus whether outsourcing it. Our concern is, how many deals have you done with the team who's handling your property management and with the team who's handling the construction? Whether it's in-house or whether it's outsourced, doesn't matter. It's, have you done 20 different property deals with the same property management team? If so, that's pretty low risk, right? I mean, you have a long, deep track record with them, and you know that they will be able to execute and manage your properties well. If it's your first deal hiring this property manager, that is a different ballgame, right? And the same goes for construction teams who are handling renovation projects. So what is the sponsor's history with the property management team and with the construction team? That's something that we've paid a lot of attention to, because the deals that we have seen either within our own the deals that we've invested in or deals we've seen other people invest in that have had a hard go of it over the last year or two, inevitably poor property management and or poor construction management has played a role. Doesn't mean it's the only thing that's gone wrong. What we usually see is a cascade of problems. They say that when a plane goes down, on average 7 things went wrong. It's not one thing doesn't cause the plane to go down. It has to have that cascade of problems. It's the same thing really with syndications. There's a cascade of problems, but bad property management or bad construction management are almost always part of that cascade. So if you can cut out that risk or cut it to near zero, it can never be absolutely zero, but if you can cut it to near zero with a team that has been operating in this market repeatedly for dozens of properties together, that cuts out a huge chunk of the risk.
Absolutely. Well said. Well said. I learned that from my mentor at Promanus, John Bogdasarian. Definitely the problem solving. When you see teams that have worked together multiple times, that have problem solved multiple times, it takes out a lot of risk, especially if they're in the same city and they're solving those same problems again and again. You're like, okay, take a lot of variables out. Yeah.
We like that. We like to see sponsors who are they live and they operate and invest right there in one city. They know it inside and out. Obviously that can present diversification challenges for them, but not for us, right? I mean, we want to invest. We want diversification by spreading small amounts among a lot of different deals, but we want each of the sponsors and deals that we invested, we want them to be really specialized, right? So we get the benefit of their specialization, but we get to diversify among a bunch of them. So that's what we love. We love that deep, narrow niche specialization with sponsors.
Absolutely. Hit the nail on the head. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.